Welcome to the final video for Intermediate Accounting Chapter 5, talking about the time value of money. And this video, we're going to talk about installment payments and we're going to talk about pension obligations, just kind of an introduction to that. However, when you get to Intermediate 2, we will dig deep into pension obligations, and it is not most students' favorite topic, and I don't blame them. It is very complicated, so I'll kind of introduce you to that today. So first, let's talk about installment payments. We've been looking at the different time value charts, the present value and future value charts, which we've seen several of each already. So now let's talk a little bit about installment payments. So first, before I even jump into that, let me just tell you, an installment payment is what we think of when we think about a mortgage or a car payment. Most loans, you're not just like making one big payment at the end of the loan period, even though that's what we've mainly seen in college with learning accounting because it's maybe an easier way to look at things. But in reality, we typically use installment payments. And when an installment payment happens, it's going to be the same amount of cash being paid out from the customer to the business every single month or year. But a portion of it is going to interest and a portion is going to go to pay down the principal. So keep that in mind as we jump into these examples. So we've got Silver Spur Leatherworks. They're expanding their operations and purchase a new saddle stitching machine. This is a company I know nothing about, an industry I know nothing about. Instead of paying the full price of $40,000 up front, the company borrows $25,000 from a financing company and agrees to pay the loan in 5 equal annual payments starting 1 year from now. The loan carries an interest rate of 6% and payments will be made at the end of each year. Okay, so what we're going to have to figure out is how much are the annual payments. Now, we're going to want to look at the present value of an annuity. So we are wanting to figure out what the payments are. When you do that, you use the present value table. Since it's payments, that's an annuity, we have a series of equal payments. And when we just do the present value of an annuity, that's an ordinary annuity where the payments are due at the end. Remember, annuity due is when the payments are due at the beginning of each period. So let's use that information to figure out how much their payments will be. So we go to the present value of an annuity table, the PVA table, and we go to 6% because they told us that was the interest rate and 5 years, 5 accounting periods. That gives us 4.2124. So what we do to figure out the payments, and this is what's happening in the real world, when they figure out your car payment or your mortgage payment, they're taking the amount borrowed by that factor, and that tells them how much to charge you every period, and then that will allow them to charge you the appropriate amount of interest and have you pay back the principal in those periods. So we took the $25,000 that this Spur Leatherworks, whatever it was, borrowed, divide it by the factor that is representative of the 6% and 5 periods, and that tells us that their payment, in this case their annual payment, is $5,934. So that is an installment loan. So Silver Spur will initially record their machine at its $25,000 cost with the credit to cash and notes payable. So let's look at the journal entries. The machine, it told us in that first question, is $40,000. It told us that they paid cash of part of it, and then they borrowed the $25,000 for the loan. So $40,000 minus the $25,000 loan, that means they paid $15,000 in cash. So we credit cash, and then we also credit the notes payable for the loan. Anytime there's a big official loan like this, where they're borrowing it for several years and there's interest, that's a notes payable, not just an accounts payable. And we've debited the machine, the assets, for the full $40,000. All right. So then when it comes to actually recording the payments at the end of each year, every single year for the 5 years, we just calculated it, they'll be paying the $5,934. But part of that's going to interest, part of it's going to go to paying down the notes payable. So to calculate the interest, you want to take the outstanding balance, which in this case was $25,000. times the interest rate. Now that's because it's for the full year. If it was monthly, we would take 1/12 of the interest rate each month. So that's going to be 6% for the whole year times 25,000. So of that 5,934, 1,500 of it goes to interest. Then we just subtract it out, and the difference is going to go to actually paying down the note. So our notes payable started at 25,000. Now it's reduced by the difference from the payment minus the interest. So we reduce it by 4,434. So here's an example of a loan amortization chart. And these are things that you can find online and play around with, but I thought it might be helpful. So with a loan amortization chart, we have the we've got the beginning balance. It was 25,000. Then we calculated the interest based on the 6% of that 25,000. Then we're going to take the difference of the payment, the 5,934 that we calculated originally, minus the interest. The rest of it goes to principal. So then the next period, our principal is going to be based off of how much we just paid down. We started with 25,000, we subtract out the 4,434, and still sitting in notes payable is 20,566. So when we calculate interest the next time, it's not going to be on the original 25,000. It's going to be on the 20,566. So it'd be 6% of 20,566. So our interest, our debit to interest expense would be 1,234. The remaining would go to paying down the principal, and we know the cash all 5 years will be that cash payment. So then we take the 20,566, the outstanding balance, minus the amount that went to the principal, the notes payable, and that tells us our new outstanding balance, which is what we'll calculate interest on the next time. So this can be really helpful in making journal entries. It can also be really helpful in real life because it will show you as well, the more you pay towards your principal, if you want to make extra payments in the beginning, the less you'll pay in interest. It is more valuable to pay off your principal in the beginning than it is in the end. All right, so your turn. The case of Maple and Maine Coffee Company. So we've got this coffee company. They're a small business known for their maple flavored lattes, and they're expanding into a second location. To fund the lease, they decided to borrow $42,000, agreeing to repay the loan with equal annual payments over 5 years with 6% interest. So very similar to the other one, but this time it's $42,000. Okay, so the present value of the loan is $42,000. The company will make the payments at the end of each year. So that's an ordinary annuity. If it was the beginning, it would be annuity due. So using the present value of an ordinary annuity formula, we want to determine the annual payments. So maybe you want to pause the video and take time to try to calculate the annual payments yourself based on $42,000, 6% interest, in 5 years using the PVA, present value of an annuity table. So now let's work through the solution together. If we use that chart, we're going to go to 6%, 5 years, just like the last example, we get 4.2124. We divide the total amount borrowed by that factor. Their annual payments will be $9,971. Did you get that right? All right, let's look at another example. We got the case of the Iron Peak Outfitters. So Iron Peak Outfitters is a company that sells rugged camping gear. They took out a loan for $30,000 to expand their inventory. They agreed to repay the loan by making annual payments of $7,317 for 5 years. Their first payment is due 1 year from now, so it's an ordinary annuity. So we know how much their payments are, we know how much the loan is, and we know how many years it's for. So what are we missing? We want to know what the interest rate is. So what we're going to do is we're going to have to work into this to find the interest rate. We're going to have to kind of work backwards. So here comes the answer. You can't wait. So we take the $30,000 divided by the payment amount, and that gives us a factor, 4.1. So we go to the present value of an annuity chart. We know it's 5 years, so we could go to period 5. We go over until we find 4.100, and that brings us to 7%. And it might be off slightly with rounding each time, but whichever one it's closest to is where you would go, or maybe it's in between two percentages. So that helps us define that they are borrowing it at 7%. They didn't get as good of a deal as the Maple Company, Coffee Company, whatever it was called, with their 6% interest. But close. 1% can really matter though. All right, we're going to jump into bonds and then we're going to do some pension obligations before we finish up this chapter. So first, just let me tell you a little bit about what a bond is. So a bond is a fixed income investment. Fixed income meaning you know how much to expect each time that you get a payment from this investment. It represents a loan being made by an investor to a borrower. So me as an investor, I get to lend someone money. So I get to be the bank. The borrower is typically a corporation or the government. So that's where you're going to get the different types of bonds. So we get more into that later, but just a little introduction into what that is. So Timber Ridge Construction Company is issuing a 5-year, $100,000 bond with a stated interest rate of 6%. That means that Timber Ridge, they're going to borrow $100,000 and they're going to pay it all back at the end of the 5 years, and they're going to pay the investors 6% in the meantime. Just like any bond, the semi-annual payments are how they pay the 6%. So they'll actually be 3% paid June 30th, 3% paid December 31st. However, similar bonds in the market are currently offering 8% annual yield. So annual interest rate. So okay, if I buy the bond from Timber Ridge, I'm going to get 6% a year, but I could go somewhere else to get a similar bond for 8%. Why in the world would I buy Timber Ridge's bond? So you're going to help the CFO, the Chief Financial Officer, calculate the issue price of the bond before presenting it to potential investors. Because here's the thing, if we're not offering as much interest as they can find somewhere else, as the investors could find somewhere else, we have to give a discount on our bond. So instead of making the investors buy our bonds for $100,000, it's going to have to be less. So this is our first introduction into bonds, which pensions and bonds are typically the least favorite topics of accounting students, and you're going to get a little piece of both of those in this video. And then you'll learn much more about them when we get to intermediate too. So calculating the price of a bond can be tricky, but let's make sure, first of all, when you see a word problem like this, it's got so much information, let's pull out what we know. The face value is $100,000. That's how much Timber Ridge will have to pay the investors after the time's up in 5 years. They're paying 6% annually, which is 3% semi-annually. So that's how they're actually paying their payments. In the market with other similar bonds, the investors could get 8%, which is 4% each payment period. The term is 5 years, but since they're making 2 payments a year, that will be 10 payment periods. This is all super important information. And lastly, the interest payments that will be made each period, the cash payments, will be the 3%, 3% in June, 3% in December to equal 6% for the year, times the face value, which in this case is $100,000. So there'll be $3,000 paid out in cash annually, semi-annually to the investors. You may want to take a picture of this slide so that when we go into the next ones, you can make sure that you're keeping track of everything. I did pull out the information so that we've still got it with us for this period, for this point. So we're going to use the present value of an annuity table to figure out the present value of these 10 payments. There's $3,000 paid out twice a year for 5 years. So we have $3,000. We go to the present value of annuity table. We go to 10 periods since it's paid out twice a year for 5 years. And here's the really tricky part. What we're trying to do is compare our bond with our interest rate, our 3% every payment period, to the market. And that's how we're going to decide what our bond price should be. So we are not using our interest rate to calculate this. We use that to calculate the 3,000. But to find the factor, we're going to use the market rate. 10 payments with 4% each would be what you could find with similar investments. So while we're paying $3,000 in cash semi-annually, we're going to multiply it times the factor that you get from the present value of annuity table with the 10 payment periods and the market rate of 4% each payment period to equal 8% a year. That gives us 8.1109. So that gives us a present value of $24,333. So all 10 of our payments, which would equal $30,000, the present value of those, considering that the investors could get 2% more a year somewhere else, the present value of ours are only $24,333. So when it comes to calculating the price of the bond, we also need to consider the $100,000 they're going to get at the end of the 5 years. So we take that 100,000. This time we're just going to use the present value factor, not present value of annuity, because the 100,000 is a one-time payment. But we are going to use the same criteria, the 10 payments of 4% in the market. So that gives us a present value factor of 0.67556. We multiply that times the $100,000 face value, gives us a present value of $67,566. So to find how much we as Timber Ridge Construction Company are going to make the investors pay us for these $100,000 of bonds, we're going to add those two together to get $91,889. So what this tells us is Timber Ridge is going to get $91,000, almost $92,000 for these bonds. But then they have to pay the 3% every 6 months, so $6,000 a year, and they have to pay the full $100,000 to the investors at the end of the 5 years. But they had to discount them because they're not offering as much interest as other companies are. Now, if they were offering higher interest, they were offering 10% and the market was offering 8%, they would actually get to charge extra for that. So that's pretty awesome. That's when you sell it at a premium. So when it comes to figuring out the actual interest expense, we would take the price of the bonds times the 4% that you could get each semi-annual payment in the market, and our interest expense will be $3,676. The difference would go off to paying off the discount on bonds payable. But again, we'll get way more into this later. I just want to introduce you to each of these ideas a little bit now. Long-term leases, another topic that we'll talk about more later, but let's just jump into them a little bit. So we've got Brightstone Studios, a media production company. They have signed a 5-year lease for a downtown office space. The lease requires annual payments of $18,000. Here's the kicker, with the payments due at the beginning of each year. So that's an annuity due. The appropriate discount rate for the lease is 7%. You will almost always see with leases that they have to make the payment up front, so that would use annuity due. The company accountant needs to determine the present value of the lease payments in order to record the right of use asset and lease liability. So the right of use asset and lease liability, this is how we are going to represent this lease, this long-term lease on our balance sheet. So we'll look at that journal entry here in just a minute. So what we know going into it, breaking out the information from this word problem, our annual payment is $18,000. This is for 5 years. They're making it at the beginning of each year. The interest would be 7%, and it is an annuity due because they're making the payments at the beginning of each year. All right, so we took that same information and we're going to calculate how much the present value of the annuity due is. We went to present value of annuity due, PVAD table, and got the factor 4.1002. We multiply that times the 18,000, that's the payments each year, and that tells us the present value is 73,804. So our journal entry, what they would actually do as the company that is going to be leasing this asset, using the asset, they debit the right of use asset for the 73,804 and they credit the lease payable. We'll get into how all of this works after this situation in intermediate 2. All right, we're almost there, but we're going to finish with something that's quite challenging, and that's the pension obligations. In the last video, I kind of introduced you to an annuity that is deferred. So that is exactly what you're doing with a pension obligation. This is where a company has agreed on some type of retirement plan for employees. Even after they retire, they're going to help make payments to them. And it can be very tricky to predict this, but that's what we're trying to calculate here is what is our obligation as a company to pay our employees after they retire. So Summit Tech just hired a new employee, Maria, who is eligible to participate in the company's defined benefit pension plan. The company estimates that Maria's total pension benefit at retirement will be $60,000 per year for 15 years. The retirement is expected in 30 years. So we're going to look at a timeline in a minute, but overall what we're saying here is she's going to work there for 30 years, is all an estimate. She'll work there for 30 years, and then she will retire and they will have to pay her $60,000 a year for approximately 15 years. All of this is just estimates, and these are done by someone called an actuary who their entire job is to estimate things like when are you going to die. So fun job. So what we get from this is the discount rate, they tell us, is 5%. They go ahead and tell us the present value of an ordinary annuity for 15 years at 5% is 10.3797. And the present value of a dollar amount to be received 30 years from now at 5% is 0.2314. So we kind of looked at this deferred annuity. We looked at it a little bit in the last video, so you might want to refresh yourself there as well. But that's what we're going to be doing here. They're saying, okay, we expect in 30 years from now to start paying Maria $60,000 a year for 15 years. So we want to start today making sure we're setting money aside so that when 30 years from now comes, we already have it ready for her. And if they can earn 5% a year, then that'll be fantastic. They don't have to set all this money aside at the last minute. So that's what we're trying to calculate. How much is our obligation right now to make sure we have enough set aside? So let's work this out together. So step 1, we want to calculate the present value of the pension benefits at retirement. So she's going to get $60,000 a year for 15 years starting 30 years from now. So that is the present value of an ordinary annuity. And we already said that that factor was 10.3797. So we take the 60,000 times that factor, and that tells us 30 years from now, we want to have $622,782 set aside, ready to start paying her the 60,000 a year for 15 years. So we're going to have that ready in 30 years from now. So now the question is, if I've got 30 years to get that $622,000, how much do I need to invest now, earning the 5% in order to get to that number? So that's where I'm gonna look at this little chart. We've got Maria. She looks like she's ready to work. So this is her date of hire. She's gonna work for 30 years. Happy retirement. Then she's gonna have an estimated 15 years in retirement. So that's what our plans are for her. So we're going to look at step 2. We've got that $622,782 that we need in 30 years. But then to figure out how much we need now, we're going to take the factor they gave us, just the present value of 30 years at 5%. We multiply the 622,782 times the factor they gave us that came from the PV table, the 0.2314. That means now we want to set aside $144,036. Then at 5%, it will grow into the 622. Then that will allow us to pay her $15,000 a year, or I'm sorry, $60,000 a year for 15 years. That's a pretty significant difference. So final answer, we take the 144,036. They're going to set that aside and invest it at 5%. That is our projected benefit obligation in order to set us up for success to be able to pay her the $60,000 a year for 15 years. So let's just revisit our timeline. We want today $144,036. That's our pension obligation. Then 30 years from now, it will grow to 622,000, which is awesome. You set aside 144,000 now, it'll grow to 622 in 30 years at just 5% interest. Then 15 years later, when she gets old, she'll have the 60,000 a year for the 15 years, and she'll be sitting there happy enjoying her coffee. So that's the end of chapter 5. You did it. This is a tough chapter, but hopefully you can see how all of these things can really apply to the real world and can help you in calculating different loans and how much money you're going to have in retirement and leases and all of those great things using these time value charts. Make sure you subscribe to my channel so that you don't miss the next video and all of the following ones through Intermediate Accounting 1 and 2.